Good morning, everybody, and welcome to our next financial webinar. My name is Michael Horn. I'm Vice President here at Final Frontiers Foundation.
Hey, my name's Daniel Nelms, President of Final Frontiers.
My name is Scott Vigneri, and I'm President of Ventana Advisors, and I'll be your presenter for today.
So, Scott, I'll let you take over and get on with what we're talking about today.
All right, sounds good. If you want to start with our first slide.
Sure, let me get that going here.
So, tax planning. At first glance, it would seem, what does that have to do with missions? And on one hand, very little, but on the other hand, quite a bit. Our objective here is to demonstrate and show different ways that you can have more funds that you can use, at least to contribute some of those extra funds to missions. And that is our hope, of course, that you would help out with Final Frontiers and some of the amazing things that they're doing. Like recently, they talked about the motorcycle ministry, and they've been able to purchase several motorcycles for several pastors. And the time saver, and the efficiency, and the safety in some cases. And for some of us, it may sound, I don't know, funny, but in some areas, it can be dangerous, not just for whatever reason, but sometimes animal attacks in certain jungles areas or pirates. Yes, some of these pastors literally live in danger every time they go out to a village or something like that. And they're hazarding their lives, literally, to get the gospel out. While I'm sitting here in my office, there is some pastor somewhere risking his life to get the gospel to a small village. And it's humbling to me and embarrassing. Here I am sitting in an office with a phone that, is allowing me to do, because my computer crashed, by the way. So what we're trying to do is demonstrate ways that we can save money and reduce taxes so that we have more funds and more access to funds. So we're going to be talking about tax spending. And today we're going to talk about some, I'll term them exotic concepts that probably very few, if any, people have heard of. So, and we're going to be talking about leverage deductions. We're going to be talking about solar and gas credits, solar credits, and oil and gas. And then we're going to talk about something called structured ownerships. We're only going to hit the high points, and I'm not going to get into detail. And obviously, these concepts are not going to be for everybody. These are typically for higher net worth type people or business owners and that type of thing. And so we're going to start with leverage deductions. So if you want to jump to the next slide, please. Nope, next one. Sorry. Leverage deductions. What exactly does that mean? Well, you get an extra deduction, but it gives you leverage. So what that means is you're going to buy a commodity or something like that in bulk. And it offers an individual the opportunity to acquire minerals, bulk materials, and bulk commodities in the same way that large institutions are able to buy it, because you are part of a organization that is buying this, but you own that asset. It is yours. It is not pooled together. One of the ones that they're using a lot right now is volcanic ash. Volcanic ash is used a lot in fertilizer and stuff like that. I forget how many tons. It's like 10 million tons, and you buy a certain amount. The thing is, you buy it at a discount because you're buying it in bulk, and you buy it directly or through an entity such as your business, if you're a business owner. And the ownership is not a pooled arrangement. Nobody else has ownership of any of your asset. Now, that pile of volcanic ash, 10 tons is owned by Joe and 10 tons is owned by Betty and 15 tons is owned by, you get the idea. But it is all separate. You own the asset, and the assets are purchased at a bulk discount, but then you donate that asset to a charity, such as Final Frontiers. And under the IRS code, the asset can be donated at full retail value. So what that means is that you're buying at a discount, but under IRS code, I want to emphasize that you can donate it according to the IRS, and I'm going to overemphasize that, at full retail. And currently, it's about a 4-to-1 ratio. For example, you put in $25,000. You buy, and that's typically the minimum. You buy $25,000 worth of the asset, and then later on you donate it to a charity. Currently, you would get a $100,000 credit or a charitable deduction for that. And you're only allowed for something like this 30% of your AGI, so that can be a carry forward. Now, if you're higher net worth, $25,000, $100,000 deduction is not really going to do you much, but you can do whatever works for you. You can put on 100,000. We have people that have been doing this for years, every year, and they've had a lot of carry forward. They still have their carry forward, but yet they keep doing it every year. So leverage, you get the leverage of buying it at a discount, and then you get the retail value. And the value is not some inflated assessment, appraisal. These are posted. You can look in a newspaper or on an article or a publication like Barron's, maybe the Wall Street Journal, or it's public knowledge. So the IRS has written these codes. This is all built on IRS code. And some of these things sound a little exotic, and they're going, I don't know about that. Well, if that's the case, first of all, it's not for you. Second of all, what typically people hear about is the abuse, either deliberately or unknowingly. And that's why I harp so much on being sure that you work with somebody who knows what they're doing. Be very careful of the old, oh, I know a guy. Make sure he knows what he's doing. There was a couple years ago, conservation easements came under IRS scrutiny. It is tax code. It is acceptable. But what has happened is that many people inflated the value. They had a little, 2-acre parcel somewhere way out in the country, and the appraiser or the person putting the value on it said, well, someday there could be a shopping mall here. And so they way overinflate the value of that property. And so that made the conservation easement suspect. And so the IRS started seeing more and more of those. So they started investigating. It is still legal under tax code. They made some adjustments, but it also became put on what the IRS calls their dirty dozen list, because they were abused. Here we have a tax code that allows you a certain tax benefit, but because people took advantage of it and abused it, either knowingly or unknowingly, and in these cases, it was knowingly. They deliberately tried to, get away with something. And so what they did is ruined it for a lot of other people, because now you got to jump through a lot more hoops. Monetized installment contracts were another one. Very viable, was tax code, but people abuse that. And again, make sure these concepts that you talk to somebody who knows what they're doing. There was another one, conservation easements. Oh, 831B, captive insurance. A lot of negative publicity about those. It's tax code. 831B is the tax code. 831A is the tax code. It allows a business owner to set up his own insurance company and to cover his own claims. It is tax code. There are certain tax benefits to come along with it, but people have abused that deliberately. So now the IRS has come in and tightened up the rules. They're still viable, but because of the publicity, people are like, "Oh, I heard about those." And be careful about that. "Oh, I heard about those." Same thing. So conservation easements. "Oh, I heard about those." Yes, we've all heard about them. So, but a leveraged deduction, it's a public knowledge. There's not any inflated appraisal. It's public knowledge, and it is tax code. Got up on a little soapbox there. All right. So leveraged deductions. Next one we're going to talk about is solar credits. And, as I'm talking, it should be emphasized, I am not a tax advisor. I'm not a CPA. I work with CPAs around the country, but I have CPAs call me. I have a CPA that just called me a few weeks ago. She wants me to help one of her clients with a defined benefit plan. But I am not a tax advisor, nor am I an attorney. To be effective, you need to have a relationship with a good attorney or attorneys. You need to have a good relationship with a CPA and an advisor. What is it? They say a three-legged stool is more stable. And it's really not any more stable or less stable than a four-legged stool. Well, I don't want to spend all that money. I have learned over and over and over and over how important using the professional is. And if the cost benefit is not there, then no, it's not worth it. I'm working with an attorney right now. He's setting up an estate plan for one of my clients. And he basically said, if the cost benefit isn't there, it's not worth it. If you're spending $10,000 to save $5,000, that makes no sense. But if you're spending $10,000 to save $200,000, that's a different ballgame. And that's what an attorney can do for you. That's what a CPA or tax advisor or enrolled agent. Enrolled agents are designated by the IRS. And it is a designation that you can only get from the IRS. And an enrolled agent, that's all they do is taxes. They don't do any of the other things, bookkeeping or anything like that. They are only taxes, which in one sense, that's good. They're laser focused on taxes. But you either need a CPA or an enrolled agent or both, and an advisor. Insurance, investments. It is worth looking into. Solar credits. They can turn a tax liability into an asset. And they can also help unlock valuable tax benefits for high-income individuals in family offices. For those of you who aren't familiar with what a family office is owned by a very wealthy family, and they hire an attorney or a group of attorneys. They hire a CPA or a group of CPAs. They hire advisors. They hire security personnel and whatever else they want. And all those people only work for that family. So that family pays their salary and they put them on retainer. They typically don't work outside of that family. And in some cases are not permitted to. They have to sign an agreement that they're not going to do any outside work. Some of them do, but it depends on the family. So it's a very, very wealthy family, and that's why they call it the family office. Somebody like the Rockefellers, they kind of pioneered the concept of a family office. Vanderbilt's, maybe Jeff Bezos has one, I don't know, or Bill Gates. But the concept of the family office, I work with a network. We have what we call virtual family office, but that's for a different day. So again, solar credits. So by acquiring solar projects, high net worth individuals can significantly reduce their tax burden while also contributing to a cleaner and greener future. Large corporations can reduce their taxes by choosing to acquire solar projects that generate tax benefits, effectively offsetting a large portion of their tax liabilities. So you actually are owner. And this, there's other solar concepts, but in this particular one, you have ownership. And there is required some activity that you have to do for each year, so many hours a year to get the credit. You get an investment tax credit from between 30 to 50%. You get bonus depreciation. And then you also can get an income stream during the holding period. And it's a longer term holding period, typically 5 to 10 years is what it usually is. So that's, we talked about leverage deductions, solar credits. Now let's talk a little bit about oil and gas. This is a big one, but we're just going to touch the surface. Oil and gas is a longer term investment, and some people don't want anything to do with oil and gas. But the problem is the world still needs oil and gas. So when you invest in oil and gas, you can take advantage of what they call the intangible drilling costs, the IIDC, depreciation, along with depletion allowance. And this concept helps in tax planning in that it allows an IDC deduction in the first 1 to 2 years. Then it provides a tax preferred income stream based on the real assets. So it can be appropriate even for high income W-2, because many times W-2, there's little things that you can, there's not a whole lot you can do. There's not a lot available, but this concept can help you if you're high income W-2. You know, you make 500 to $1 million as a W-2 employee. And we do, you know, I have a client that is $1 million W-2. Let's see. It can be appropriate for high 1099 or W-2 income earners, helping with Roth conversions or required minimum distributions or in the sale of a business. It can also help with diversifying your portfolio. And it provides a non-correlated asset to equities and bonds. For those of you who aren't familiar with correlation, non-correlated means that if the stock market is up, then this one is down. If the stock market is down, then this is up. It doesn't quite work exactly like that, but it's not dependent upon the market. It's not dependent on bonds. It's not dependent on stocks. It moves on its own. Yes, there is some influence, especially as we become a more global economy. There are factors, but it is not as correlated as other assets. It can provide a long-term income stream that can be reinvested, and you can compound those returns. So the main thing to remember there is that you get a credit for intangible drilling costs, and then you get depreciation, and you get a depletion allowance. The first 1 to 2 years is where you get that credit for the IDC. And then you get an income stream over that period of time. And that's just one concept inside of oil and gas. There's many others. All right. Let's take the next step. Structured ownership. Most people have not heard of this either. Everybody's heard of oil and gas, but many have not heard of these type of things. Structured ownership can reduce the client's out-of-pocket expense from 23.8 capital gains tax rate plus the state income tax, or 37% of ordinary income tax plus income. And it can reduce that 23.8 down to 13.5 or 16% with full liquidity. It doesn't require a charitable structure. As we talked about with the bulk commodity and the leverage deduction, you need to use a charitable structure for that to get the credit for that. But this is not required. You can take the entire basis tax-free in the case of capital gains. Reduction of a capital gains or ordinary income in the year the plan is implemented. And there's a possible carry forward if the business loss exceeds income. Sounds pretty complicated, doesn't it? It is. It is a bit. But if you're a business owner or a higher net, these kind of things don't scare you. How does it work? The client makes a capital contribution of 10% in the case of capital gains income, or 12.5% in the case of ordinary income of desired tax deduction. What that will do is the client will get a negative K1. A K1 is a tax return form for partnerships that will offset income of 10 times capital gains or 8 times ordinary income of their capital contribution, plus a one-time 3.5% administration fee on the total amount. The taxes will be deferred for 15 years. So this is obviously a long-term project. And then can be deferred another 15 years and so on until the client is able to receive a step up in basis as current law permits. There are no additional fees to renew deferral. Client will receive a 3 to 5% income on capital contribution, but will not receive capital contribution back. If you get the capital back, then you're going to have tax issues. So here's a slight example. A client sells real estate or a business with $1 million worth of capital gains. The client contributes $100,000 into a master limited liability corporation. The client will get a negative K1 of $1 million to offset capital gains. The client will then pay a one-time administration fee of 3.5% on that K1 amount. Client's total out of pocket is $135,000 or 13.5%, rather than paying the tax of 23.8% capital gains plus state income tax. And then the client will receive income of 3% to 5%, $3,000 to $5,000 income per year from the original $100,000 capital contribution. And I realize that we may have people here that are going, this doesn't apply to me. I don't have that kind of money. I am trying to reach these people that do have this kind of money to help them see how they can help missions. And hopefully some of these, when they do word searches and SEO and all that kind of stuff, this will come up and they'll check it out. And they'll want to give to missions and help get the gospel out. There are many Christian businessmen out there and they love missions. I am working with one down in Texas. His life goal is to give as much as possible when he dies to missions. And right now we just we're setting up a plan with an attorney and an estate planning attorney. And he is taking action. And he's a businessman and he has this kind of money. And for those of us who don't have that kind of money, well, let's make our contributions as well. God can take that dollar. You know, let's not forget the story of the widow and the 2 mites in the Bible. Who did Jesus notice? He noticed that widow that put in her 2 mites, and he said she gave more than all of them. Yeah, here's a guy, he's got $1 million, and he put in $10. She put in 2 mites. It was all she had, or very, very close to all she had. But she loved God, and she wanted to give back to God. And that's what this is all about. God so loved the world that he gave his only begotten Son, that whosoever believeth in him should not perish. And so we want to do whatever we can. And God sees our heart. And yeah, I can only give $1, or I can only give $20. This guy can give $1 million. Well, praise the Lord, he's given it. But praise the Lord for this person who's given the dollar. It is incredible how far $1 can go in other parts of the world. We have that one pastor that is in a foreign country. He has several children. He goes soul winning all day long. He only needs $300 a month to support his family. That's all he wants. $1 can go a long, long way. So I want to encourage, I don't want to go, yeah, you don't have a lot of money. No, I'm just trying to attract more of these kind of people to help get the gospel out and to get more funds for the gospel, because we have a wonderful Savior. And I want to do my part to help get the gospel out. If I could buy a motorcycle, I'm going to do that. If I can buy, help put a building up, I'm going to do that. And so I'm educating everybody. And maybe you know somebody, maybe you don't have this kind of income yourself, but you know somebody who does. And you said, hey, you need to check this out. And let them know. So tax-wise for missions, as I said in the beginning, all charts, numbers are for illustration purposes only. I got to do this for the legal. Accuracy is neither warranted nor implied. We are not attorneys or tax advisors. This information is educational only, not to be considered as advice or recommendations. It's imperative that you consult with a tax advisor and or attorney when considering any of these concepts. In addition, here we go. It is critical that the attorney, tax advisor, and advisor are knowledgeable and practiced in these areas. And you can reach out to either Michael or Daniel. And if you want to talk to somebody, they can send you in the right direction. So I want to thank you for being with us. I had a little technical glitch. So if anybody's got any questions, I'll be happy to answer any questions.
I'm not seeing any questions at the moment, but there's definitely a lot of things I've never heard of. So some interesting concepts for some of those who are able to do things with gas and solar.
Yeah, and the ability to count off more than you actually spent in the. Wow, I wouldn't have thought something like that would be a thing.
Yeah, it's in the IRS code.
Sure.
It's nothing. Many times people think, oh, that sounds, because we're not familiar with it. But when you read 401ks, nobody knew about a 401k until a guy named Ted. Ted sat in the library one day reading IRS tax code. And he studied Section 401. And he studied Section 401k. I said, hey. And that was the birth of a whole industry.
Oh, wow.
But many people are now discounting that, because is it really a benefit to take the tax deferral now and then pay the taxes later? It's the old Farmer Brown. They tell the story of Farmer Brown's out in his field, and a black car pulls up, and two guys with dark sunglasses step out with the little earpieces, and they just stand there. Finally, he goes, what do they want? So he goes over to him. Are you Farmer Brown? Yeah. He said, we're the IRS. And we've got a question for you. Okay. Do you want to pay taxes on the seed, or do you want to pay taxes on the harvest? What do you think Farmer Brown said? What would you say? And I'm going to leave it at that.
Like a lot of variables in there.
There are.
Yeah.
Seed's probably cheaper than the harvest, but You could fail. I don't know.
That could happen too. But yes, something to think about. But, all right.
Well, thank you everybody
Hopefully-
for joining us.
Yes,
we hope
sir.
You've enjoyed.
It was
enjoyed this one.
intriguing and educational. I learned things that I never knew. It's always good.
And we'll see everybody next month.